What's up, future CPAs? All right, today we're basically becoming accounting detectives. We're going to crack the code on a topic that, trust me, is 100% going to show up on your LECPA.
So, what's the big mystery? It all boils down to this one question. How do you even account for a salary when it's not paid in cash, but in company shares? Sounds tricky, right? Well, our guide, our rulebook for this whole investigation is PFRS 2. It's got all the answers.
Okay, so let's get into the nitty-gritty. Here's our case file for Marin-Duque Corporation. And yeah, this probably looks super familiar because it's pretty much a classic exam-style problem. We've got the grant date, who gets the options, what they get, and the conditions. The big question we need to answer is, what's the compensation expense each year? Let's break it down.
Okay, first up, the grant date master key. You know, every investigation has that one clue that unlocks everything. For us, it's this core principle of PFRS 2.
So first things first, let's just make sure we're all on the same page. What even is an equity-settled share-based payment? It's really just a fancy way of saying the company is getting services, from its employees, and instead of paying them cash, it's paying them with its own shares or options to buy shares. Simple as that.
And here it is. This is the golden rule, the master key, the most important thing you need to remember. You measure everything based on the fair value of the options on the grant date. In our case, that's P16 per option on January 1, 2020. I'm going to say it again. This number is our anchor. It is locked in. It will never ever change during our entire calculation. Got it? Cool.
Okay, detective mode on. Step 1 is to figure out the total potential value of this whole deal. So we take our 120 employees, multiply by the 100 options each gets, and then multiply by that sacred P16 fair value. Boom, P192,000. Think of this P192,000 as the entire pizza. This is the total cost we're going to have to account for. Our job now is to figure out how to slice it up over the years.
All right, on to part 2, recognizing expense over time. So we've got our big P92,000 pizza. A company doesn't just expense the whole thing in one bite. No way. They spread it out, slice by slice, as the employees are actually earning those options.
And that time the employees spend earning their options? That's what we call the vesting period. It's basically the time they have to work to unlock the reward. In our case, the best guess from the start is that it's going to take 4 years. So what do? We recognize the expense over those 4 years, slice by slice.
So let's do the math for year 1, 2020. We start with the total value, that P192,000. The vesting period is 4 years and 1 year has passed, so we multiply by 1/4. And that gives us P48,000 for our 2020 compensation expense. Easy peasy so far, right?
Okay, part 3. And this is where things get interesting. What happens when estimates change? Because let's be real. In the real world, things never go exactly as planned. This is where we separate the rookies from the pros.
So, plot twist, at the end of 2021, we get a new clue. The company now thinks 8 employees are going to leave before the options vest. Our original guess of 0 leavers was a bit too optimistic. So, what do? We got to adjust.
Now listen up, because this is super important. We do not go back and change the P48,000 we booked in 2020. That's in the past. We account for changes in estimates prospectively. That means looking forward. So here's how we do it. First, we recalculate the entire pizza based on the new info, so 112 employees now. That gives us a new total value of $179,200. Then we ask, at the end of year 2, how much of this new total should be recognized? Well, 2 out of 4 years have passed, so that's $89,600. Finally, we subtract what we already booked last year. The difference, P41,600, is our expense for 2021. See? We're just catching up.
And what do you know, the plot thickens again. At the end of 2022, we get another update. Now the company expects a total of 12 employees to leave. So, guess what? We got to adjust our numbers one more time. But don't worry, we've got this. We use the exact same logic. Step 1. Recalculate the total value with the newest number of employees, that's 108. Step 2. Figure out the cumulative expense that should be recognized by the end of year 3, that's 3/4 of the new total. And step 3. Subtract everything we've recognized in the past 2 years. The result? $40,000 is our 2022 expense. You see the pattern now, right? It's a system.
Okay, here we are at section 4, the grand finale. market conditions, and the solution. This is it, the final year. Let's crack this case wide open.
And bingo! On December 31, 2023, the share price hits P90. The market condition is met. But wait, here's a massive point for your exams. Listen closely. A market condition, like a share price target, does not change the amount of compensation expense we recognize. Say what? Yep, we still recognize the expense because the employees did their part. They provided the service. The market condition just decides if they actually get to exercise the options. It's a trigger, not a measurement tool.
So for our final calculation, it's the moment of truth. We don't use an estimate anymore. We use the actual number of employees who stayed until the end, 105 of them. We calculate the final, true total compensation value based on these 105 employees. Then, like before, we subtract all the expense we've recognized over the past 3 years. And the final piece of the puzzle, our 2023 expense, is P38,400, and just like that, case closed.
All right, we cracked the case. High fives all around. Now, let's switch gears and create your ultimate LECPA cheat sheet for this topic. This is the detective's handbook you'll want on exam day.
So here we go, a rapid-fire bullet review of the key principles of PFRS 2. These are the absolute non-negotiables you gotta know.
Okay, get ready to screenshot this or write it down. 1. Always measure at the fair value on the grant date. 2. You recognize the expense over the vesting period, not all at once. 3. You adjust prospectively for changes in non-market conditions, like employees leaving. 4. You do not adjust for changes in market conditions, like the share price target. And 5. The journal entry credit goes to share premium, share options. Burn these into your brain, they are everything.
All right, LECPA hack number 1. The grant date fair value is sacred. It never changes. I'm telling you, exam questions love to throw in the fair value of the option at the end of year 1, year 2. It's a trap. Ignore it. It's just noise. Only that grant date value matters for calculating the expense.
And LECPA hack number 2. Always think prospectively. When your estimates change, you only look forward. You never ever go back and restate last year's expense. The formula is your best friend here. It's always the new cumulative expense minus the previously recognized expense. That's it. That's the formula every single time.
Okay, final pop quiz to see if you've been paying attention. What if, at the end of 2023, the share price only hit P89? It missed the target. What would the compensation expense be for that year? The answer? It would still be $38,400. Why? Because the employees held up their end of the bargain. They worked for 4 years. The company received the service, so it has to recognize the expense. Whether the market cooperates is a whole different story.
You know, the great Warren Buffett once said, accounting is the language of business. And by really digging in and understanding something as complex as PFRS 2, you're not just memorizing rules for an exam, you're becoming fluent in that language. You're learning how to tell the real financial story of a company. So keep at it and good luck, future CPAs. You've got this.